Okay, good. I'm Tigran, and before starting my presentation, I'd like to know how many of you has some... So how many of you has some experience with the financial sector, like with the banks or some other institutions? Please raise your hands. Okay, good. Let me tell the following. Like, we all know that data science can be interpreted as a mixture of a couple of fields. Like, there is this domain part, there is the math and statistics part, right? And there's the programming part. And what we are actually trying to do at Protogen AI is to bring together the expertise of all of these fields and build innovative products for the financial sector. And I'm going to show you in a more detailed way what kind of products we have currently and what we are working on for now. So here's the content of the presentation. We will start from machine learning use cases in financial services. Next, I'm going to talk about predictive modeling in credit risk management. And next, we'll talk about linear versus nonlinear classifiers. And I'm going to finish the presentation with the credit risk management engine that we have built at Protogen AI. So let's begin. First, the credit scoring part. So what is credit scoring? What are those scores? I'm sure many of you has some experience with taking loans from the banks and knows how this works. So what is the score? This is just a number that tells the bank how good or bad the given borrower is. And based on this, then the decision maker at the bank decides whether to approve or disapprove the loan. So this is a very important thing for a bank, because this is the main source of making money for a given bank, for a credit bank. So in terms of real world examples, I would like to bring the example of Zest Finance, but there are also other startups and fintechs that work in these fields. So this is just one representative example. Zest Finance applies big data analysis to credit card data. They do actually scoring, and they got $272 million investment in 2016, and they actually, with their models, they reduced a lot the default rate in credit portfolio, which of course results in higher profits for the bank. So they actually had a very successful case in China working with the search engine Baidu. This is just one example that may summarize what's going on in this field, in this startup and fintech realm in terms of credit scoring. But on top of this, if we build up more, central banks may also use this kind of techniques, more innovative techniques, in order to develop machine learning based algorithms for credit scoring. And why I'm saying this, because they possess the data of all the systems. So for example, the credit bureau data, so they have even bigger data than separately commercial banks may possess. They may do real-time monitoring of credit quality with some financial stability implications, and they may provide already trained algorithms based on this systemic data to new entrant banks, which may be an important factor. So a new bank without any knowledge about the economy may possess the already trained algorithm and may freely provide loans. Yes, the question. Yeah.
that you would normally have.
Actually,
Well.
actually, you mean about the false positives and false negatives about this thing? Yeah, actually, those are here. Yeah. No, here the number of the default rates is presented here, like they decreased the default rates, but in terms of, for example, Baidu, they show that Zest Finance increased their profits. So I don't know what's the percent, what's the share of rejecting good borrowers, let me put it that way, but overall they increased significantly their profit. So, I mean, if you Google, you can learn a lot more about this case. All right, so just one other thing, another example of a potential use case of machine learning. This is an example, again, for the central bank research. So here we can see the following. There is this dark line, which is called sentiment, and there is this green line, which is the entropy. So what is the sentiment? So the data is actually textual data here from many news agencies. And if there are many negative words in terms of like the assets go down, the prices go down, then the sentiment goes down. And if the market is bearish there, and vice versa. If there are positive words, prices go up, it goes up. Here we actually can see. So this begins from 2004 and ends in 2013. We can see that during this period of pre-crisis of 2008, the sentiment was high. So this means actually the following, that many people were talking about rising stock prices, about good economic conditions, about economic boom and this kind of stuff. Afterwards, after 2018, it is this line, it goes down. So there is the crisis and everyone talks about negative stuff and about falling prices of the stocks. And the other one is called the entropy, the green line, the yellow line. This is about the concentration in these articles. So if people talk about just one thing, this goes up. If times are uncertain, people talk about many things, about different things, this goes down. And we can see that, again, during this crisis period, this indicator goes down, which means that the uncertainty rises during this crisis period, and people talk about different things. So this is, again, just one example of a potential use case in the banking sector of a new kind of data, textual data, which is and sentiment analysis, which is something new for this field. So there are even more applications, just to name some of them, like fraud detection or robot trading and customer analytics for marketing, or contact center automation via chatbots, and HR analytics in terms of predicting the churn rate of employees. So this is about the, this was the blog actually of the machine learning use cases in the banking industry. Now let me talk about the predictive modeling in credit risk management. So actually this works well for the retail banking because there is a lot of data there. For large corporates, there is not so much data, and there are lots of other subjective factors, other political factors that usually machine learning does not do well there. But for retail banking, this works really well. And the case of Zest Finance was also on retail banking. Now, what machine learning algorithm does there, it takes some indicators of a given borrower, may also take some other indicator of a general economy, and provide as output these final scores based on which the bank makes its decisions. And here, in terms of predictive modeling, we have three approaches. Those are the traditional methods, machine learning methods, and hybrid approach. The traditional methods are mostly linear. Those are parametric methods. Yeah, and those are simple methods. They may be very simply interpreted, but they do not generalize well. So usually that's the case. Because there are highly nonlinear patterns in the data, and they won't provide good predictions. Next, those are machine learning methods, those methods that work well currently in the industry, in the financial industry, are non-parametric methods like decision trees, random forests, or boosted algorithms. And so those are methods that require no prior knowledge, so pure machine learning methods. And they may generalize well on the data if you have a big, very good representative or high quality data. So if you put it this way, but usually that's not the case. So still there are issues of how representative the data is, and we have the hybrid approach, where we have the machine learning algorithms that work well as predictive algorithms, but still we should impose some prior knowledge to these algorithms. And this is the difficult part, and this is the part through which the decision maker, the final policy maker, gets more comfortable with the algorithm. So it becomes less of a black box algorithm for the decision maker. All right, so this is actually this is very important slide because this summarizes a lot of my experience here. I want to contrast linear approaches with non-linear approaches. So here is the thing. Let me put it this way. So let's imagine the x-axis here is the age of a borrower, and the y-axis is the income. And let's assume that green dots are good borrowers and red dots are bad borrowers. So this is historic data, and the bank knows that who is good, who is bad. And based on this data, the bank wants to develop a predictive algorithm. So at the end of the day, many people talk about AI, about robots, about complicated stuff, but at the end of the day, this is about linear separation from non-linear one. So using machine learning techniques, we can get non-linear separation of green dots from red dots, and that's the whole point of doing machine learning for this kind of data. Because, as I said, there are very non-linear patterns in the data, and we can capture these non-linear patterns with machine learning algorithms. So this is, of course, an ideal case where there is a 100% separation of green dots from red dots. But still, in real life, non-linear separation works well. Because, let me contrast it with linear separation, and again, the same data without any separation. And here we have the linear separator. What traditionally banks do with these linear and parametric models, they get this kind of separation. So they say, here they say this blue line is the separator, and they may say everything which is above the line are good borrowers. Let's say they predict this way for the new data, for the unseen data, are good borrowers, so they assume those are green dots, and everything below the line are bad borrowers. They assume they all are red. So the difference is that, so here's the thing. The difference is that there are lots of misclassifications here. On one side, and the question also was about that in the beginning, from one side they allow loans to many bad borrowers above the line, those red dots. And also they reject many good borrowers, their loans, the green dots below the line. And so the idea of using machine learning, of improving this procedure of lending and lending policy making, is to have a nonlinear separator that separates in a better way the green dots from red dots. All right, so to complete my talk about this part about contrasting linear methods from nonlinear methods, I'd like to tell what kind of issues we faced while working with this data. So one thing is how to incorporate the macroeconomic variables in the models. Those might be like continuous numbers, continuous variables, or some discrete states of macroeconomic variables like recession, boom, and stable period. The forecasting of macroeconomic variables, one thing to get external forecast, the other thing is to use machine learning methods. And we have an example of predicting the rate of inflation of Armenia using machine learning methods, and we get better prediction than the other models or forecasting agencies like the intelligence unit of the Economist provides, and maybe this may generalize to other variables as well, besides inflation. So there is the data limitation and unbalanced data issues, because the default rate is usually lower, like 10% of the whole portfolio may be defaulted, and 90% are good loans, 10% are bad loans, this kind of issue. And there is the time-varying structure of the credit portfolio when the bank provides loans, collects the portfolio, and after like 2 years or 1 year changes some policy, like concentrates to other segments as well, and gathers like additional data points, like borrowers from other sector, from other industry, let's say in like green technology, startups, let's say. So this which changes the structure of the credit portfolio. And finally, there is this black box structure of the algorithm, which is the issue of how to communicate this to policymakers. And also there are some issues when you work with time series data. First, how to deal with seasonality, like standard issues, the non-stationarity of the data, and how to choose the right legs and of the model, and finally how to do the cross-validation, and one of the most important things, I would say, how to do the forecast evaluation, because there are lots of techniques, and you can imagine anything there. So based on this, mentioning all of these challenges, I would like to say that at Protogen AI, we have methodologies and approaches on how to deal with all of these issues, and we communicate all of this with our clients, so to make it very clear. And based on all of this, I would like to show you how the system works. This is the credit scoring system for lending policy. First, there's the input data about the given borrower. This goes through an outlier detector, which means that when a bank provides loan, the bank may not have all the data about the system, so there might be some outlier cases. If this is an outlier, this may go to manual analysis if the bank wishes so. If not, then this goes to ML system. Afterwards, the ML system outputs the PDs and scores, based on which first there is the approval and disapproval part, and afterwards there is the risk-based pricing. So if some borrower is a good borrower, then the other question is how good he or she is, and what's the price of the credit that the bank should provide the loan to that borrower. So this is the part of risk-based pricing. And finally, this is my last slide actually, there are accounting standards and requirements imposed to the banks, like IFRS 9 standards on how calculate, let's say, the expected loss on portfolio. And they require to incorporate the macroeconomic part in the system. And for this, we also have macroeconomic blog where we calculate historical PDs and do macroeconomic scenarios, and we do also transformations for lifetime probabilities of defaults, which may go to the machine learning system and output individual probabilities of default. So here I'm going to finish my presentation, and thank you. If you have any questions, we can go to that Q&A part. Thank you.
Many thanks to all of you for sharing this day with us. This year's Munich AI Summit was devoted to the role of women in AI. Looking forward to Munich AI Summit 2020. See you next year.